investor doing things on your own? How about someone working with a firm that isn't so responsive or in sync with your investment philosophy? My podcast talks you through all things financial. Look, there's stuff you don't deal with very often, but investments, insurance, and retirement is something we plan for each and every day. This is the Pennywise Financial Podcast, and welcome to the show. All right. Welcome to the Pennywise Financial Podcast episode here, April 7th, 2025, with my co-host today, Dave Georgiev. Welcome to the show, Dave.
Hey, thanks, Const. Thanks for having me. Glad we're back on the air. Nice to be back in touch with everybody.
Yeah, I just wish it was under better circumstances, I guess.
Agreed.
Right. On the heart and minds of pretty much everyone right now, in focus is tariffs and how that's playing a role in your accounts, right? Because people hate losing money. We hate losing money.
Yeah.
We also hate when our clients lose money because, basically the way that we've affiliated with our clients is that we're charging a fee based on the assets that we manage.
Yep.
Which I think is the most fair way to do things.
So sell. We should sell right now and hide it in under our pillows.
Yeah.
No?
No, I don't know. I don't know if that's the answer.
It's what we get a lot of calls right now, and I'll tell you, and I'm not trying to make light out of any of the chaos and uncertainty going on in the market, but the last thing that you can do or should do is act emotionally in these types of environments. I mean, time and time again, I've been in the business 22 years now, and I have never, ever seen somebody act emotionally with investing and have it be in their best interest and have it work out well for them, truthfully.
Never. Not once.
Yeah.
And it's hard to time that, right? So you get out when? Should you have gotten out a week and a half ago? I don't know, maybe.
Yeah.
You would have saved 10 or so.
Yeah.
When do you get back in?
But then what if you got out today? Okay, let's get out today. You're already down. I mean, honestly, the NASDAQ's down 20%, 19 and change right now. You get out now, and then when do you get back in? When you should get back in or when you should be buying, nobody wants to buy because there's fear in the market. And that's the way it's gone historically. I don't know if it's Warren Buffett, but I'll give him credit for it. Somebody said you should be buying, it sounds horrible, when there's blood in the streets. And that's exactly the case. When everybody's running out of the building, you want to be running into the building. And that's easy to say, hard to do when all you see in the media helps us in no way by just perpetuating this horrible situation well after it's done, So we'll continue to monitor and see what's happening.
Well, that gets ratings, right? It's not like, hey, today's going to be partly cloudy and a mild 75. That does nothing.
Yeah.
But tornado winds and this and that, I mean, you got to build up a storm.
Mm-hmm.
Storm is a brewing.
Mm-hmm.
A couple things I'd like to take a look at is some CEO reactions, right? So when you think of like the overall economy and what people are doing, I just listened to the CEO of Restoration Hardware and talking about what they've done. Now, if you think about Restoration Hardware, they import a lot of stuff, right? They get a lot of stuff from China.
Mm-hmm.
They've since moved some of that stuff to Vietnam, and I know some have moved to Korea. But when you think of some CEOs that have a really good connection with the overall economy, I think of J.P. Morgan Chase, global bank. Jamie Dimon, I know, was in support of Trump and obviously some of the things that they had going as far as the campaign. But Jamie Dimon. So here's some reactions to the announcement of the tariffs, right? Issued a blunt warning stating that tariffs will likely increase domestic inflation and raise the probability of a recession. I don't know if that means an actual recession, but the probability is going up. More concerningly, he highlighted the potential damage to long-term U.S. economic alliances if other countries retaliate, and we've already started to see some of that retaliation.
Mm-hmm.
He acknowledged that some unfair trade practices exist, but stressed the need for careful negotiation rather than sweeping tariffs. He expressed hope for positive long-term effects after negotiations, but remains very cautious about the country's financial future. What are your thoughts on that?
It sounds like this is what I hear across the board. Everybody has an opinion, but nobody knows where any of this is going.
Correct.
Have we seen anything like this? And I don't have the answer, truthfully, about have we seen anything like this to the caliber of the reciprocal tariffs that we've now issued across the world to long term how that pans out. I don't think we've ever in the last 50 years seen to this caliber like the amount that we've imposed on these other countries. And by the way, most of these countries, even as we've reciprocated, our tariffs are still lower than the tariffs they're charging on our products and going into their countries.
Isn't that crazy? That just shows you how much of a deficit there was and has been for years and years.
Absolutely. Absolutely.
Um, Again, I guess the next question would be: is it better to progressively raise tariffs? Like today, we're going to do 10%. In 3 months, it's going to go to 15. In 3 months, it's going to go to 20. Next year, it goes to 25. Or is it better in a sweeping mass saying, okay, we're going from a 5% tariff to 45?
Yeah, which is better? Tough to call.
I mean, I think
I'd rather get it done.
I would too.
Yeah.
And we talked about this when we were looking at raising rates. Do we do a quarter every month, or do we do 50 or 1% just in one day and call it done? And
Yeah.
then you rip the Band-Aid. I think of my kid, he gets hurt, he gets a little scratch on his arm, and do you rip the Band-Aid off like in one swoop, or do you say, okay, let me peel a little off right now, and in another hour I'll do a little more? I don't know. To me, I'd rather just rip the whole damn thing off.
Sure. But it's funny that you said that about the interest rates, like when we go to rise or lower interest rates, because I actually, and I don't have I don't have a thorough answer, but I actually like the slow increase in interest rates rather than boom slap. So say at the beginning of this year they were talking about 3 or 4 interest rate hike or lowers this year, and now it's kind of maybe 1 or 2. But to just dump 50 basis point lower versus 25 and 25, I think you're able to kind of see how things go. But I don't know, for tariffs, I'm the exact opposite opinion. Like, I'd rather, let's just come to the table. And I truly think this is what President Trump wants to do is let's just get back to the table of renegotiating this stuff, because it's been one-sided, tremendously one-sided for far too long, and nobody spoke up against it. And so I think this is why he's trying to have such, that, and he is a bully, like him or don't like him, he's a bully. I do believe he's advocating for the American people in this regard, of we've been getting ripped off for decades, and I want this to stop. Again, I don't always agree with the way he goes about doing it, but I think it's going to bring people to the table. And I heard a report this morning that over 50 countries have reached back out to us to try to renegotiate this stuff. So the goal, in my opinion, is that people will come to the table well ahead of time, so a lot of these tariffs won't stay long term.
And I have to say, like it or hate it, isn't that the campaign that he ran?
Absolutely.
He's delivering on that promise, which was, I'm going to have sweeping reform.
Yeah.
Right? Radical change. And, it's just so fast, I think. People don't know how to take it, don't know how to react.
Yeah.
And he may be, and I'm hopeful of this, is that he's 5 steps ahead of everyone and not knowing, like, what's the end game.
Yeah. Well, I'd say this too, though. Like, he's the president, and I didn't vote for Joe Biden, but I tell you, once Joe Biden won, like, okay, that's our president. Now I hope Joe Biden makes good economic decisions and good social decisions. And the same thing with Trump. Now that Trump's in office, he's our president, and I want him to do what I believe is best for our country. Again, I don't always agree with the way he goes about doing this stuff, but I do hope that this process leads to a better, more efficient, more profitable America to come.
Yeah, one other, we looked at, that's Jamie Dimon from J.P. Morgan, just another financial one. Think of David Solomon, the CEO there. He stated that business continuity and business community understands the intent behind the tariffs. He acknowledges the desire for lower tariffs globally, but recognizes the president's overall goal. He noted that some market uncertainty as the tariffs are digested, but indicated a watch and see approach. And like you said, I feel like we all have an idea of what's trying to, what the end game is, but we don't actually know. And I think it leaves a lot of people scratching their head. Like, my accounts, my investments have just been whacked 15, 20% in just a matter of a week or two.
Yeah. Yeah. And that's the biggest thing is the market loves, right? The market loves good news. Market's okay with bad news, actually. But the market, what does the market hate? Uncertainty. What's happening in today's world, geopolitical world? A whole lot of uncertainty. And that's what we're dealing with. And then don't forget on the other side, and you mentioned this earlier, Cons, the cuts in federal spending. right? So you have the tariffs going on. That's a train wreck. That's, up in the air. How is this all going to pan out? But then you have Elon and his team at Doge doing the cuts in federal spending and cutting all sorts of programs, good, bad, and indifferent. I'm not going to comment on all of that because I don't know the details of exactly what he's cutting. They gave a lot of examples at the State of the Union. And some of it was crazy. And some of the Social Security fraud that was happening, you had 200-year-olds collecting Social Security, people older than our country collecting Social Security. And that's going to save us a ton of money. And the goal from this current administration is to make Social Security become tax-free.
Wait, there's something wrong with a 150-year-old collecting?
I don't.
Let that sink in for a minute. Let's take a quick break, and we'll be right back with the show. Are you a business owner looking for ways to save for retirement, keep and attract top talent, or maybe just save the amount of taxes you're paying? We have solutions to help all size businesses, from solo practice to mid-sized firms. There's a ton of tax incentives just up for grabs. Your employees will thank you for giving them a platform to invest in their future. If you have a retirement plan in place and you're not sure the best way to set things up, reach out to me, Constantine at Monarch Wealth Management, and I'll help you understand your options and know what you own. Not all advisors understand retirement plans, so make sure you're working with a knowledgeable team and experience the Monarch difference. All right. Welcome back to the Pennywise Financial Podcast. We're talking tariffs, potential for recession, and the overall reaction to that by the economy. And we're talking to a lot of different people, business owners, our existing clients, about how they're feeling. And I can say it's overall pessimism right now. Stock market is reacting to that. What do you think about recession?
I think we're gonna hit a modest recession, and if not, we're gonna graze it by God's grace. Honestly, I think we're gonna be right near zero GDP, a little bit positive or a little bit negative. Quarter one, quarter two, maybe into the third quarter, depending on how all this finalizes. You know what I mean? What's your take?
I don't know that we'll actually get to that point. I think, and I'm hopeful that some of these tariffs are just like bargaining chips, and this doesn't drag out. The longer this drags out, the worse it gets for everyone. I don't think there's any winners if this goes beyond 10, 12 months.
Yeah. Well, things to consider, too. You hear all the horrible stories from the cut side, like going back to the Elon story. And a lot of people are like, oh, we didn't elect Elon. Well, it's like, yeah, we didn't elect Dr. Fauci either, but that changed the geography of the course of human, history in 2020. So they're appointed. We get that. The federal government, all these employees, and my heart breaks for people losing their jobs, truthfully, but the federal government represents about less than 5% of the workforce in the United States.
No
So just to
kidding.
kind of put that in context. Actually the largest, though, this is the problem, though, because a lot of people, because I hear both sides of the argument, and they both have valid points and concerns. But part of the argument was he inherited one of the best economies in history. But 2024, one of the largest sectors of job growth was the federal government.
Shocker.
Yeah. And so, at times I feel like they just created jobs to make the data look better. And again, that's why you're seeing so much fat being cut from our federal government right now.
Well, this is, it's hard for us to think about like tariff wars and going through it. And I know history doesn't always repeat itself. It might rhyme, right? But there's been different points throughout history where we've had tariff issues and tariff wars, if you will, that have affected the market. And they've given us reason to sell, right? And I go back to some times in history. You look at the Smoot-Hawley Tariff Act in 1930. Obviously, in response to the Great Depression, you think of some tariff wars and U.S. trading partners that led to a sharp decline in international trade and arguably deepening the global economic crisis. Many economists view this as a major policy error that exacerbated the Depression. You're coming off a depression. Now, we're not in a depression. If you look at earnings on most S&P 500 in the first quarter, they've been in line, and I think that even throughout the rest of 2025, most are looking positive, right? Despite what we're seeing right now.
Yep.
So that's promising. That's going back to 1930. If I look at another point in time. You look at the post-Civil War era, late 19th century, following the American Civil War, U.S. adopted a policy of high tariffs to protect domestic industries. While not a war in the modern sense of broad retaliation, these sustained high tariffs did create trade tensions with Europe nations. Right? The chicken tax of 1964. Never heard of the chicken tax. You?
Better
Chicken
not.
tax. I don't
Better
know what
not
the
tax
chicken
my
tax
chicken.
is. I think of. Never mind. We won't go there.
Moving on.
This was a more targeted trade dispute. In response to the tariffs proposed by West Germany on U.S. chicken imports, U.S. retaliated by imposing a 25% tariff on potato starch, dextrin, brandy, and light trucks. We like to drink. I don't know about brandy,
Brandy.
but I don't. Brandy is like an older drink.
Yeah, my uncle drinks brandy.
Does he?
Yeah.
Well, they say drink brandy if you have like a stomach ache or something like that.
Really?
It's supposed to help soothe your stomach, something like that. Other points in time. Tariffs on Japanese motorcycles, 1983. This probably, to me, this sounds a little bit more like specific. Like maybe the U.S. looked at it as a threat. You think of Harley Davidson. Anyway, 1980s Harley Davidson, the sole remaining American motorcycle manufacturer, faced intense competition from Japanese imports. U.S. government under President Ronald Reagan imposed significant tariffs on heavyweight motorcycles to protect the domestic industry. These tariffs were phased out after 5 years. While a targeted measure, it illustrates a case of tariffs used for protectionist purposes. So again, you think of Trump and you think of all the things he's doing right now in response to the unfair trade practices we've had, right? These tariffs that have been placed on us.
Yeah. Well, if we take a look, though, and we see, like, why are we doing all this? Why is he doing all this? And part of the strategy, at least, that they've unfolded for us,
Yeah.
for us.
It was all wrapped
is-
up. They've unfolded.
Yeah, I know. Is planned tax cuts. And one of the planned tax cuts is to make Social Security benefits tax-free, income tax-free from a federal level. Like, that's huge for our retirees, for our senior citizens, to now have tax-free, completely tax-free Social Security. Like, that's one of the goals. I've even heard some things that long-term, some of the goals are if you make under $150,000 a year, that you will no longer pay income taxes. I mean, can you imagine how that helps the low and middle class citizen? I mean, the people that all these politicians always say they're fighting for, but then when you look at legislation being passed, none of it has to do with helping those people. They go and they campaign in the inner cities and in the rural areas across the country, but then once they're in office, they don't do anything to help those people.
Well, I think of those two segments you just mentioned. One, Social Security. It's retired folks, probably lower income, right?
Mhm.
Maybe not so much dependable income as far as Social Security, but tax. But then the people making less than $150 a year.
Yeah.
Right? That would have a more traumatic impact, I think, on those people to have no tax or lower taxes.
Yeah. So imagine, because the tariffs will, like, if they last long and this actually happens, the products that we buy will become more expensive. Everything will become more
Absolutely.
expensive. Even U.S. built stuff, because the wage that we pay here is tremendously higher than China and all these other countries. So if we're buying American-made products, typically they're more expensive. That's why we buy all this China stuff, this Chinese junk. A lot of it is. So now, if everything's American-made, if this fully pans out, everything's going to be more expensive from a cost standpoint. But now the added profitability, this is the goal at least, the added profitability that the government's making on tariffs is now getting rid of these taxes. So you pay more for products, but your taxes are non-existent or very low. So net positive. I mean, think about if you make $150,000, I'm just throwing some numbers out there. If you save $25,000-$30,000 a year in taxes, compared to what are they saying, that the this whole tariff regime should add another $3,000 of cost to each person or each family a year,
Yeah.
because of the increase in cost of all of the stuff that you're going to be buying. So I'm adding $3,000 or $4,000 in cost, but now I'm saving $25,000 a year in taxes. Again, this is the thought process. This is the goal, if they will. Not to mention that, so there's planned tax cuts, and then there's also the potential for fiscal stimulus from Congress. So they were talking about from all this money that they're saving on, from everything that Elon and his team's finding. And I don't want to sound like I'm advocating. This is just
Wait, through Doge.
through Doge, yeah.
Doge.
is that they're taking some of that money and they're going to plow it into paying off our debt, but then part of that money might become a stimulus check to each American.
I think a lot of that could come to fruition. Also, think of interest rates.
Oh,
You
yeah, I was
know,
going to bring that up.
not even like the president has the power to lower rates, right?
Mm-hmm.
But by virtue of the scenario we've created,
Yeah.
how about this?
Yeah.
Rates are going down.
Yeah,
What if we could refinance a lot of that debt at a lower rate? It's
absolutely.
very possible.
And that's some people, some people that go down those rabbit holes. They're like, Trump tanked the economy on purpose to lower. I'm
Oh,
like, take it
I
easy.
hope not.
Dude, I don't think so. I don't think.
He
But
just gave an interview on Air Force One, and they asked that question, and he said, I think he said that's the stupidest question I've heard. Why would I want to crash the economy?
I did hear
You
that.
know,
Yeah,
he said something to that
Yeah.
effect, almost verbatim, but
literally. said
not
that.
surprised.
Yeah. So do you think the feds will lower?
I think short term, yeah, there's a possibility. It's crazy, and like you mentioned, do we do a big hike or decrease in one shot or one swoop? If they do that, I mean, think of all the analysts last year, what they were calling for.
Mhm.
We're going to raise 6 times.
Yeah.
Oh, wait a minute, we're going to decrease twice. Oh, wait a minute. Like
I know.
it's like steering a boat, right?
Yeah.
And you're going 60 miles an hour. If you jerk it to the right too far or too far to the left, you're going to have all kinds of problems.
Absolutely.
Slow and steady, little movements, little tweaks here and there, I think can go a long way. Except with tariffs. I mean, maybe a big turn, and then maybe we get right on course.
I know, it's so
We've been
funny.
off course though for so long.
Yeah.
Right?
Well, they paint him out to be a villain, and in a lot of things, the guy is a villain to a certain degree, and the way he, this whole Canada thing, and I'm not even talking about the tariffs, just the 51st state rhetoric. Like, I don't think it's necessary at all. But again, that guy's clearly a lot smarter than I am, so maybe there's some grand master plan there. Same with Greenland. Like, if you want to talk about coming with us and joining us as a country, like, okay, have those conversations. Bull in a china shop, now Greenland hates us, Canada hates us, but again, I don't always understand the way he delivers this news. You know what I mean?
Yeah. The intent is there. It's just the execution sometimes.
Correct.
With that, let's take a quick break, and we'll be right back with the show.
Do you have a high deductible insurance plan? If so, have you set up your HSA? There's a ton of people who don't know what it is or how it works. Even worse, there is an underserved segment of the population that can't get advice from their advisor about how to make the most of these powerful and unique programs. Not many advisors focus on this in their practice, don't understand the mechanics of how they work, or even where to begin helping their clients. Reach out to me, Constantine at Monarch Wealth Management, and I'll guide you through this process and get you on track to make the most of your high deductible plan and your superhuman HSA. That's 585.
Welcome back to the Pennywise Financial Podcast with my co-host today, Dave Georgiev. We're talking tariffs, we're talking Trump, we're talking the impacts of your investments, what we're doing about it. One thing I'd like to say, I think of what I'm talking to clients about, what I'm talking to prospects about. If I sat down with a client 5 years ago and I sat them down and I said, I'm going to give you 5 different scenarios. We'll see a positive 15, a positive 10, a positive 8, and a negative 20. But I can't promise the order of those returns. Obviously, I'd like to take the loss up front, right? Get it out of the way and just have those perpetual gains throughout. But I'm pretty sure that any rational investor would be like, okay, sign me up. I'll accept those returns. I don't know which order they'll be in, but that's pretty much what we're facing, right?
Yeah.
If you look at the last several years, we've had a few years where we had some hiccups, some missteps, and we had COVID, and we had some weird years where there was some unusual activity. But if you're investing, you have to accept that, right? When people sign a contract and they go ahead and open a brokerage account and they put money to work, they understand that the market goes up and down. And this is one of those times.
Well, yeah. And I think that sticking to the game plan that you have with your financial advisor is so crucial in these panicky, emotional moments. It's like, what is the goal of this money? And this is kind of going back to some basics. What are my goals with this money? What am I trying to do? What is my time frame? What is my risk tolerance? And if you were aggressive or growth, and now you're like, I don't like this loss, well, don't change your risk tolerance now. I'd say wait it out. And then once you recoup any money that you've lost during this downturn, then have that conversation with your advisor to say, I did not like this to the point that I lost sleep or I was constantly stressed or whatever the case is. I guess based on this, I'm maybe not in the risk tolerance that I thought I was. But to make that decision now when you're negative 10, 15, 20% is foolish, truthfully, to reallocate to a more conservative allocation at this point.
And duly noted. And I would say the same is true for when the market's up, right?
Oh, yeah.
Hey, I made 15, Dave.
Yep.
Why am I not up 20? Can we
Yep.
take on a little bit more risk? That's probably not prudent either.
Yeah, absolutely.
How many times do you have that conversation with people? It's like, great. And people have a short-term memory, right? They forget about it. Because 4 months ago, people were gung-ho. Hey, this is fantastic. I've seen 10+% the last several years. Let's go a little more aggressive. Let's take on more risk. And it's like, maybe that's not appropriate.
Yeah, absolutely. And don't forget, like, just some long-term statistics that I actually, again, it's so good to take a moment, breathe, take a step back, and analyze the situation. So since 1980, the S&P, so that's what, 45 years old, 45.
Yeah,
Yeah.
45.
We're 1980 baby, so we should know this
Oh,
easier. Hey.
here we go.
So the S&P has averaged over 13% a year since 1980. For the last 60 years, the S&P's averaged about a 10% rate of return. But since 80 to now, 13.5%. Positive returns in the S&P 500, 84% of the time. And over 45% of the time, the index has returned more than 20% on any given year. 45% of the time over the last 45 years.
And so think about that. That means a static. I've taken my money, I've invested it regardless of the market conditions, tariffs, who's in president, what's happening in the economy in the world. The scariest of times when it seems like the sky is falling and I should sell everything, go to cash. Give me any good reason I should be invested. Despite all that, positive 13%, you're saying average a year.
Yeah, over the last 45 years. That's crazy.
It's hard to fight the U.S. It's hard to fight the economy when you see numbers like that.
Yeah. Well, even when you think about it, these are scary times, but are they really? I don't want to minimize anything, but like, are they really scary? Do you know what's scary for me? September 11th, 2001. You had, planes running into buildings and chaos and craziness. That was scary. The '08 meltdown. That was scary from literally a fiscal dry up, almost like a motor that ran out of oil. That's literally what we had because of credit freeze, because of all these big institutions going out of business. If it wasn't for the bailout, and I am not pro government sticking their nose in, but if they didn't stick their nose into that, I don't know what we'd be looking at today. And I remember the Dow was down around 6,300. 6,300. What's the Dow at now? 37,000, 38,000? I mean, it was in the 40s just a couple weeks ago. But just think about that. That was 15 years ago. 6,300 was the low. March 9th, 2009. After the '08 crash, it continued to go down. That market was down just under 40%. Do you know how long you had to stay invested to get back to even? Was 3 years after that. 2012 was when you finally made your money back. That was the worst market we've seen in my lifetime. You know what I mean?
I can remember '08.
Yeah.
I remember it very well. I think we had jammed appointments from morning until night of clients worried, sick. Do I get out? Do I sell? I'm down 30, 40, some people 50% if they were aggressive.
Yeah, but do you know how many people that I work with now that I didn't work with back then? And they're like, "Oh, Dave, I don't want to take the risk of '08. Like I lost half of my portfolio." And I'm like, "Tell me what happened." And this was it, time after time. We were invested in a equity portfolio, in a stock portfolio. Market tanked. We sold out because the market was tanking. And then we went into guaranteed stuff.
Ooh.
And now I'm meeting with them in 2014, 2015, and they've been sitting in guaranteed accounts, earning next to nothing for 4, 5, 6 years. And they have a fraction of what they had before. Why? Because they panicked. They acted emotionally in a time where you should stick to your guns. And again, it still would have taken time to make it back, but you would have been made whole. And then if you remember from 2010 on, that decade, you made money hand over fist.
Yeah, it's funny you mentioned '08 and clients and the way they reacted. I actually have a client that I started working with about 10 years ago. And in '08, he did just that. He sold and went to cash. So he lost 30+% went to cash, went to guaranteed fixed income, either bonds or something like that. So he ate that loss, wrote it down, ate the loss, went to cash, and it took him several years to get back in. And by then, obviously, the market was
Yeah.
up big time.
Yeah.
So now he sold low and bought high, just the opposite of what we preach. And it's easy for us to sit here and say that because clients are very emotional. It'd be like doing an operation on one of your children. You get very nervous about things.
Sure.
You wouldn't
Sure.
react. The blood is flowing. You behave like you wouldn't normally do. When we meet with clients and it's a good market, right? They always say, "Oh yeah, I'm okay with losing 20, 30%." Right? Everything's fine then.
Till they lose 10. Yeah.
Correct. I do want to pull up a chart. Let's pull up this chart here, looking back. So I think this is kind of important. It's somewhat relevant, right? Because we're talking about the drawdown now. And if we look at this chart, it goes back to 2020. You think of pretty traumatic times. You think of COVID, and God only knew what was going to happen next. Everybody was scared to go to the grocery store. I know I was. I would shop late at night and get nervous. And anyhow, but let's look at the period of 2022 to 2024. That market was essentially flat. Who's talking about that?
Mm-hmm.
This is the S&P 500, right? We're going back from 2022 to 2024 to break even on the S&P 500. It's kind of staggering to look at that chart and say, was that right? I had to do a double take when I saw this chart, and I went back and I did the research on it. But you go back and you look at the COVID and those COVID years, and it rebounded pretty quickly. But 2022 was a kind of a challenging year, I think. 2023 was obviously a better year in 2024, and moving on through the rest of the months in the later end of 2024, market rallied quite a bit.
Yeah.
And here we are now, and we've seen a rapid decline. And this is like pure chaos in just a couple of months. And most people, most investors, most clients are referencing this is one selfish person doing this. And, I have to think we put a lot of faith and trust in our leader, right? Regardless of who's in power. But this kind of puts things into perspective, right? If we look at any one given period of time, whether it be a couple months, you extrapolate that out over 5-6 years, and it's almost a blip on the radar.
Yeah.
Right? And there's always points in time when we look at times when we want to sell. I mentioned that a few times when we looked at tariffs, but think of the stock market crashes. Look at 1929, market was down 89%. In 1974, the market crashed. It was 48% down. In 87, it was down 23%. In 2002, it was down 49%. 2009, 57%. This is S&P. In 2020, market was down 34%. Now, in 2020, it was a little bit different, right? Because it was obviously based on COVID, and it came back pretty quick. Matter of fact, a lot of clients didn't even
Very
realize
quick.
they lost money
Yeah.
because that rebounded basically in a quarter.
In the same quarter.
In the same quarter.
Yeah,
So
yeah.
you got your quarterly statement, and all of a sudden it was back to where it was. Did something happen? Obviously people are watching the news or watching TV.
Yeah. But do you remember that I remember watching CNBC or whatever investment channel, and a lot of those economists were calling for a double dip. Remember, it started coming back up, and they're like, "Oh, don't be fooled by this. This is going to not be a V-shaped recovery. It's going to be a W. We're going to see a double dip on it." Well, it never double dipped, and in fact, tech and all those stocks soared through the roof during that time.
Well, I think it's a valid point to say that we don't invest based on A, emotions, but B, politics, right? Regardless of who's in power, there's always going to be opportunity. It might be a different place to make money.
Yeah.
Doesn't mean you shift all your money from cash to gold to stocks to bonds. Having a little bit in different places, I think, makes a lot of sense. But you don't want to own every single asset class all the time. You just don't. When you think of those stock market crashes I mentioned, pretty much 12 to 24 months beyond that point, the market was up big.
Yep.
You've already realized that loss, so it can only get better from that point on. And like you said, you think of investments in the S&P 500. In 1929, if you had $500 and you invest, now this is going back a lot of years, but that'd be worth $1.65 million, that $500.
Yeah.
And not trying to time the market, not trying to worry about politics, not trying to worry about tariff wars and what that might or might not happen or have an impact on your investments, but staying invested, I think, all the time. and just moving things around a little bit.
Yeah. And so, I mean, and to give anybody listening that works with obviously other financial advisors, just to give a little bit of a break to everybody in our industry, right now, most financial advisors are getting, uh, just inundated with calls, emails, messages that people are panicking. If you are concerned with your investments and you do want to talk to your advisor, you should call them and they should call you back or email you back in a reasonable amount of time. But this goes back to just strategic planning over the long haul. And I think about some of the moves we've made in our portfolios. We made some tactical allocation tweaks at the end of 2024. And then in early 25, we saw some things that, we wanted to make some adjustments for. And probably 10 days before all of this real chaos, we even buttoned up some tweaks in some of these portfolios just to hedge a little bit more. Again, we're never going to, just because the wind changes directions, we're not changing investment philosophies because of that. That's foolish. That's chasing returns. That's trying to time the market. That's dangerous. And that's not the type of investing that we look to do. But at the same time, if we see the storm on the horizon, I made this analogy today. If this is a lake house property and we see a storm on the horizon, okay, we're going to put some sandbags down. We're going to board up the windows. The hurricane's coming into town. But ultimately, we're going to make these tweaks, but we're not selling the house. We're not moving. We're just getting ready for the storm. So if there's some tactical things we can do in the short term to just offset some of those losses. So instead of 20% losses or 15% losses, now we're down 10% instead. Nobody likes losing 10%, but it's way better than losing double that. So that's the type of strategic implementation that we want to have in place. And again, working with a financial professional is going to help you during those times. Vanguard's done studies that show that a person that works with an advisor over time averages, what is it, a 3% better rate of return in the long haul.
Yeah, it's about 3 and change.
Yeah. And that's not always, let me be crystal clear on that. That's not always just straight up investments. That's all the advice you get from your financial advisor over time in regards to anything financial from, do I lease or buy a car? Do I pay off my mortgage early? Do I pay off college debt early? All of those kind of things. When you average all of that together, it turns out to be just over a 3% rate of return. So,
yeah, I think that. First of all, it's valid. I mean, I have a lot of people asking questions like prospects, and I think there's a lot of people that are nervous right now that they're with the right person, right?
mm-hmm.
And so they're coming, reaching out to us and saying, like, how are you guys different? And everybody preaches they're holistic and everybody preaches they do financial planning, but I think this is the time where we shine, where we show our value, where we are more relevant in people's lives. It's not the times when the market is up 15% and you say, great, we're up 15 and the market is up 13 or vice versa. It's staying invested, being in front of our clients, giving them some commentary and rationale as to what's going on and reinforcing our game plan, right? It's a targeted approach. It's not how much did we make this year and how much are we going to make next year. It's a long-term goal and getting you there in that path.
Do you know what's one question that I never get during these times, which boggles my mind? Dave, I don't have no clients ask me this.
I can't wait to hear this question.
Dave, what are you doing in your portfolio right now? Nobody ever asks me that. And I'm kind of like, I do this for a living. I mean, almost a quarter century now. And nobody asks me, Dave, what are you doing in your portfolio? And it's like, well, because the answer is this. We've made our tactical decisions, our tactical allocations, our strategic changes over the year, over the quarter. Now we just ride out the storm. That's what we do. We've already done everything that we've wanted to do to this point. So now we're not going to act emotionally. We're just going to, batten down the hatches and see how this thing pans out, And that's what I would recommend to most people, and people one-offs have these crazy, well, in my situation, and I get that, but we're kind of painting broad strokes here in this discussion.
Yeah, I think the biggest question I've been asked, and it's crazy, you would think just the opposite. People are reaching out and, asking questions about the economy, et cetera, but I've had more people reach out in the last couple of days since Friday and even this morning on what are the best places I should be investing. I want to add money. So think about this. Market's down, you scared, terrified. Yeah, they've got the bulk of their money invested, but where else should I be putting new money to work? And those are the questions you should be asking right now, right?
Absolutely.
Where are the opportunities? That's where the wealthy know how to position themselves and invest when the market is down. Do you want to buy that shirt when it's $50 or when it's 25? You know, obviously you want to buy cheap and sell high. You don't nail it exactly right, but those are the things that people should be asking and thinking about right now.
Yeah, sounds good, Cons.
With that, I think that's all the time we have for today's show. Thanks again for listening to the Pennywise Financial Podcast. This episode is April 7th. And what are we seeing today? Some pretty violent weather. We're also seeing some turbulent markets in the economy. Thanks again for listening.
You've been listening to Pennywise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is Pennywise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.